the next gauge is valuations, and obviously we've seen stock prices fall. You guys have left that unchanged at neutral. What are you, and from an investment standpoint, market standpoint, could you expand on that a little bit?
Yeah, at the end of the day, investing is about getting value, right? When you're purchasing something, you want to make sure that the price that you're paying, is worthy of the enjoyment, and when you're buying stocks, you're really buying earnings and growth prospects. The price to earnings ratio is just that. It's the price of stocks compared to the earnings of the companies. It was close to its highest level in 20 years, following the pandemic. Now, that kind of makes sense when interest rates are lower. It also makes sense when earnings, as they were very strong and growing aggressively, were present. But what we've seen currently is actually earnings that have been growing, although slowing in their pace of growth. They're still growing while prices are down, somewhere between 15 to 23% in the stock market so far this year in 2022. What that's basically, shown up as is price to earnings multiples coming down to what we would consider pretty fair levels. We do not have the valuation gauge in kind of what we would consider stocks expensive territory. Now, there's some debate, should the gauge be positive? Should the gauge be neutral? Because interest rates were moving up and set to continue to move up, and obviously things can cost more when interest rates are lower, because rates are moving in the opposite direction, we opted to keep the gauge neutral. But when you look at actual price to earnings multiples, we are trading slightly below the last 30 to 40 years worth of average prices. Generally, you do see that earnings drive stock prices over the long term. Politics and fear and greed and emotion and exuberance and excitement, they clearly have an effect as well over the short term. But what really drives prices over the long term is earnings. Earnings are actually looking pretty decent this year. We've seen earnings expansion in 2022 after a record year last year, and yet we're still seeing the stock market come down. So I think we can say for the first time in a while, stocks are no longer expensive compared to history. And while it's unpleasant to go through those contractions, it is healthy to know that stocks purchased today are trading slightly below their average price over the last 30 to 40 years. The last point I would make on that is that stocks compete with bonds, and when you look at treasuries, stock yields are still in positive territory compared to what you get from treasuries. So we decided to keep this gauge in a neutral position because stocks are not cheap exactly, but their valuations have improved a lot, and they're reasonable given where interest rates are. And I would add, from our perspective as an active manager, we look at valuations on a company by company basis, not just the entire market. And the recent volatility that we've seen has provided us, a lot of opportunities to be in high quality companies at what we feel are pretty compelling prices. And to make real deliberate investments in this environment. So that's kind of what we think about valuations currently. Definitely some positive news there from where we've been last year.
Yeah, anytime you hear that the word opportunity and investing, that's a good thing, and that's what I'm hearing there.